This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello, and welcome to Clear Money Talk. I am your host, Tim Clairmont, CEO and founder of Clear Financial Partners. And as always with me, the wondrous, the illustrious, the amazing co-host, Tyler Andrews.
Thanks, Tim. You haven't used the illustrious in a while.
I know.
I like that one.
You're welcome.
It's unique. You don't hear it.
I'm looking at your
often.
hair. It's particularly shiny today.
Oh, thank you.
It's.
I fluffed it up for the podcast.
I'm envious because I barely have a few hairs left on my head at this point. You know, that's all that wisdom beaming light off of my head just burns all the hair away.
Burns your hairs off.
That's right.
We've heard that one before. If you're a dedicated Clear Money Talk fan, you've heard Tim use that one before.
Yes, you got to find the good ways to feel better about your hair going away and your forehead seemingly getting larger. At least that's what's happening to me.
Your forehead's becoming a 5-head, maybe.
It is. Yeah, that's good. I like that. I don't like that, but I do like that.
Yeah, you like it.
It's a mixed emotion. It's a mixed emotion. Thanks, Tyler.
Yeah, you're welcome.
All right. So what are we talking about today? We're going to talk about money today. Clear Money Talk.
Another rousing Clear Money Talk.
And I have no idea what the topic is again.
Like always.
So it's so much fun when Tyler just gets to pick the topic and spring it on me, and we get to see where this goes. So
all right. Topic of the day: what are the biggest money myths holding you back?
What are the biggest money myths holding you back?
Yes.
Okay. All right. Nice.
So the way I wanted to structure this one is I did a little bit of research, came up with some more common money myths that people use to justify doing or not doing something. I just wanted to talk through those with you. So I'll just go one by one. We'll talk about some common money myths, and then we could talk about maybe our outlook and our feelings about those, how maybe it does come into play when people are making money and financial related decisions, and just get our insights about that stuff.
Got it.
What do you think?
I think it's great. I think it's funny. The two things that come to mind that I don't know if they're on your list yet that I feel like are common money myths that really come up a lot, and maybe we'll throw them in there if they're not on your list.
Sure.
Are the 4% rule, which in a way is a money myth.
Yep.
And then the rule of thumb about your age and your bond allocation.
Which
is definitely
those are big ones.
Those are a couple big money myths that
those are more
mind,
green for sure than some of the ones I have here.
Yeah. Well,
but those are good. Maybe we warm up with some of the easy ones.
Let's warm up with the easy ones, and we'll see if we can hit those other two harder ones. What do you got for us today?
All right. First one is you need a lot of money to start investing.
Oh yeah, no, you're right. That's a very common money myth, and no, that's totally not true. So let's talk for a second.
Yeah.
Myths means that this is something that a lot of people believe, but in this particular case, there's no facts to really back it up, and that's what we're talking about here. So and if anything, in general, oftentimes these are wrong. So the myth here that you need to have a lot of money in order to start investing is just not accurate. Of course, if you had a lot of money and you invest it and you do well, you can have even more money and have better returns and better experience, and that's great. But you don't have to have a lot of money to get started. That's just not true.
Yeah.
How did you get started, Tyler?
How did I go? Well, one of the most common ways to get started with investing is your employer-sponsored retirement plans, whether it's a 401k, 403b, 457, just depending on the nature of your work will dictate which of those number and retirement plans is assigned to it. But yeah, I mean, that's one of the easiest, lowest hanging fruit. You can potentially have an employer match that's added on top of your contribution. So it's really an awesome, easy way to get started. And with new legislation that has come out recently, a lot of employers are now mandated to offer retirement plans to their employees. So the days of saying, my employer doesn't have a retirement plan is kind of becoming something that's a thing of the past. So that's really one of the first ways I started getting investing back when I had my first 401k offered to me. But nowadays, more than ever with technology, you don't even have to have a 401k to begin investing. If you have some amount of money that you say, I am comfortable to invest this, there are many custodians and brokerage institutions that will even let you buy fractional shares of different stuff, whether it's stocks or ETFs or mutual funds. You don't even have to buy a whole one of those shares. If it's too much to buy one of those shares, you can actually buy fractional things nowadays. So it makes the barrier to entry to investing a lot easier for people. Whereas back in the day, that wasn't a thing. Probably when you started investing in the industry, fractional shares were not very common. So you had to have enough money to buy one share, and if you didn't, then maybe you said, "Well, I can't invest because I don't have enough to start doing that yet." But there's all these things that are happening to make investing more commonplace for the general public, which is awesome, if you ask me.
Yeah, no, I concur. I agree. And with mutual funds, I mean, the concept of mutual funds, I think it's been around for a very, very long time. And the fundamental nature of mutual funds, where you get a fractional ownership in a pool of diversified assets, allows you to potentially also take that small investment and actually have it be a little piece of hundreds or even thousands of companies with just a little tiny investment, which is a neat opportunity as well that really revolutionized investing for I would say the mass affluent and the majority of Americans, and that the presence of those mutual funds in most 401k plans and 403b plans, as you just talked about, is one of the other sort of easy button options for getting started with investing. I want to be clear. I'm not advocating that you should invest or that you should invest more money or invest less money, or that should go aggressive or conservative or any of that. We can't give you advice in a general capacity like this on Clear Money Talk like that. That's very personal for you to determine. Does it make sense for you to contribute to your retirement account versus deal with other things? You might have some debts that you need to pay down that are at very high interest rates, or maybe there's some emergency expenses that are going to be, you need to have that money in place to deal with some of those other issues. But fundamentally, a common money myth that you need to have more money, a lot of money to invest is just not true. It's just not true anymore. It's even less true today than it was before. But I would say it even wasn't true a long time ago.
That's fair. Yeah, totally. Yeah.
What else you got for us?
Okay, next one. Debt is always bad.
Oh, debt is always... Yeah.
I feel like we've talked about this a little bit in previous podcasts, but it's definitely a controversial topic and myth, I think. Depending on who you ask, you'll get very hard answers on their belief set, and there's nothing right or wrong with that stuff. We're not here to say debt is good or debt is bad. Just depends on how your relationship with debt, I guess, is built. And everyone's relationship with debt is built differently.
Yeah, that's fair. I think there are certain clients that we have, certain people that you meet that just have that philosophy that they believe debt is bad, period. And that's just the way it is. And there's even certain religions out there that kind of, ascribe to that philosophy. And I don't want to argue against that. If that's your belief set, totally okay. Yeah. But I will say that for me, when I think about debt, it's function of the interest rate. It always comes down to the interest rate. Let me give you 2 examples. So let's say that you owed $10,000 on a credit card that was at a 20% interest rate. Okay, so at the end of the year, you're going to have another $2,000 of interest owed, 20% of the $10,000 at the end of 12 months. So now your debt, if you didn't make any payments on it, theoretically, your debt would be $12,000 instead of $10,000. That's very expensive. That's $2,000 is a lot of money you just had to pay to a credit card company. You didn't necessarily get any value out of that. Odds are whatever you spent the $10,000 on probably didn't earn you $2,000. There are certain circumstances where you just have to have money and that's your only choice, and it is what it is, and you try to get it paid down. And I understand that. It's one of the challenges we all deal with. That's why it's important to have an emergency fund and make sure you have adequate income and that you're spending less than you're making. But that's one example of what I would argue most people would agree is bad debt. I don't think a lot of people would say that's good debt or even be neutral on it. 20% interest rate is pretty bad. That's a
pretty high
interest rate. It's good debt for the credit card company because they're collecting that 20%.
Yeah, so that's a great example. In your situation, it's bad for you, good for the credit card company.
Depends on which side of the deal you're on. But let's go to the absolute opposite of that. Let's say it was a 0% interest rate. Let's say you had $10,000 at a 0% interest rate, and you only had to pay $50 a month till the debt's paid off. It would be in your best interest to take that extra, $10,000 and invest it and earn. Even if you had it in a savings account or at the bank or a CD earning 2 to 4%, you're making interest on money that you owe no other interest on to the other party. So for you, it could make more sense for you to actually, as long as you're earning more than the interest rate you're being charged on the debt, that's the kind of debt that, as a financial advisor, I would argue can be good debt and can allow you to leverage other wealth in order to generate a higher rate of return. So it really does come down to how much interest are you paying on the debt versus how much interest are you earning on the money you pulled from the debt. And that's the key differential. And obviously a 0% interest rate or a very, very, very low interest rate, 1 or 2%, if you take the money and you do something smart with it that ultimately makes you more than that interest, financially you'll end up with higher net worth, and that can be advantageous.
1% to 2% interest rates.
I know.
Don't we miss that?
We do. Those were good times.
Those were good times.
Yeah. Don't see that very often anymore.
No, we don't.
No.
I feel good about that one. You ready for the next?
Yep.
Okay.
Let's go.
Renting is just throwing away money.
Oh.
Yeah.
Okay, well, that is a money myth. I think it's actually a simple way that a lot of parents like to teach their kids to buy a house or other, let's say wise gurus might want to teach other people to, not waste money on rent because I can subscribe to that. I agree. I feel like renting in some ways is wasteful. However, the cost of acquisition of owning a property, when you buy a property, for example, there's a lot of hard dollar cost that goes into that. And once you spend money on that property, there's usually a period of time that you need to hold that property for, just to allow, hopefully, the appreciation of the property to offset the costs that you paid up front. And I'd say most investors would argue that typically a 1 to 2 year period of time is a good minimum to hold a property before you're planning on selling it, unless you're going to do something to it, like the flippers and things like that, where if they buy it or they buy it for a really good deal and then they do work to it to try to enhance the value or do something to it and then they try to sell it in a shorter period of time. I'm not advocating for or against that particular strategy, but for most passive investors that are going to own where they live rather than rent, I'd say holding the property for at least a couple of years is usually a good way to offset some of those hard dollar expenses. So if you're in a more transient situation where you've got a short-term job scenario in for 3 months or 6 months in a particular area, renting during that time makes perfect sense. Or if you don't have certainty about the length of your time frame that you're going to be in a particular area, maybe you'll be there for a long time, but maybe you won't be. Again, renting can make a lot of sense because those hard dollar costs that you forfeit up front to buy the property are not often recouped for at least a couple of years. And if you don't know if you're going to hold the property for a couple of years, that's a good reason to consider renting. And we have to have a roof over our heads. So if you can't afford to buy, you should probably rent. So it's not necessarily a bad thing to do that either. It's not necessarily throwing away money if it keeps you dry.
Yeah, I think that's important. I think, mobility is an important one. When that's one of the things that comes to my mind is what you hinted on. If you want to have a mobile sort of lifestyle and not be stuck to one place, or if you're in a short-term employment situation, renting can definitely make sense in those situations. And I think back to also the great market rush and for real estate where everybody was trying to buy a house all at the same time back in 2021 and early 2022 when interest rates were at all-time lows. And maybe that wasn't the best time to be buying a house. So maybe renting would make sense at that time because you didn't want to be crazily overpaying for a property just because everyone else was doing it, so you felt like you had to do it too. So some people maybe decided to continue renting because they didn't want to be in that grouping of people doing all that. And
it's true. I get where you're going with that, Tyler. Yeah. I thought of that same thought as well. I was hesitant to go there just because I don't want to advocate market timing. I do think that predicting the value of real estate, even though it may seem high right now, doesn't mean it's not going to just keep getting higher. It might. And on the other hand, if you believe it's high and you think that the real estate market's going to crash, clearly you should probably be renting in the interim and then buy when it's low. I don't like to make bets like that because I think it is a bet when you're doing that, but it is a good reason to consider renting.
No, and I was thinking more along the lines of, well, maybe you just can't afford it. House, it's expensive right now. You just can't afford it, even if you wanted to. You couldn't afford the mortgage, so you have to continue renting or whatever that might look like. Mm-hmm. But I think it's another. These myths are fun because I don't think there's a one-stop shop answer. Yeah, it's a conversation.
I agree. It is. It is. I think it's an entertaining. It's an entertaining conversation. So
it is. Any other words on this one?
One last thought on the renting. So I had to learn this the hard way. So it's always fun. It's always fun when you get to hear from a financial advisor that you respect and listen to, and they tell you about their money mistakes. So let me tell you about a money mistake that I made. I decided that I was going to buy a vacation property, and I got a vacation property up at Mount Hood. Ooh. And I overspent. I thought it was going to appreciate a lot and everything else was great, and it didn't. It had all kinds of problems that popped in. I just figured, I'd get some tax breaks and things like that, trying to rent it out and do all this other stuff. Anyway, ended up not being the best investment strategy. I think I walked away about what I paid for it after several years, not counting all the HOA fees and all the time and the blood, sweat, and tears that I put into, going up and visiting the property and everything else. But what I learned from that is exactly the reason why I think this renting, renting is throwing away your money is a myth. I don't want to own a vacation home. I don't want to own a beach property or a second residence or things like that, because I feel obligated to go out and visit that property all the time. And I prefer variety when I want to go on my vacations. I don't mind staying in different places and doing, having that sort of variety experience. And then I also feel like I have to take care of that property all the time, whether I'm there or not. And I worry about it, and that'll cause me stress. And, all of the emotional impact associated with owning a property like that as a second home is something you really need to think about. And I'm not saying you shouldn't have second homes. Some people, that's exactly what they need, and that's exactly what they want. And there's nothing wrong with that. But for me, I would rather take the money I was going to be spending on that home, total that up, and then say, how much can I, now that's my vacation budget. Now I can use that money to spend on my vacations instead of sinking it into taking care of a property that I felt, burdened by. And that's, that was a good life lesson for me that I share with you so that you can hopefully avoid the pain of it.
I like that. I like that example. So thank you for sharing that, Tim.
Sure.
Yeah. Ready for the next one?
Yeah. What else you got?
Credit cards are the enemy.
Ooh, credit cards are the enemy. That's a myth, huh?
Depends who you ask.
Yeah, I guess it depends if you're the credit card company.
Okay, well, let's talk about both ends. Yeah.
Okay.
Why would they be good? Why would they not be the enemy? Why would they maybe be your ally, your friend?
Yeah, I think sometimes when you look, if you're in general, I'm going to agree with this myth. I'm going to say credit cards they're not so much the enemy that we need to cut them all up and not use any of them. Some people really do need to do that because they need to get the self-discipline of not using the credit card, get out of debt, and improve their situation. But most of us, I think you can use credit cards to generate some really positive reward benefits. I use credit cards all the time. It's convenient for tracking, and as long as you pay it off every single month, you'll never pay any interest. And so that's the way I do it. It's a great way to track your expenses on different types of expenses, so you can have different cards for different purposes. And as long as you pay it off every single month, you don't have to pay any interest, and you can earn the points and the reward benefits and all of that. So I would say they're not the enemy if you use them right. The other element is if you don't have enough financial resources to actually have emergency money, and you have an emergency that hits you, credit cards could be your only resort for accessing money that you really need to get your hands on to deal with some life crisis. And that in that scenario, they can be your salvation. Just understand they come with a cost.
Yeah. I'm just trying to think what else I would say.
I know. Sorry, I just took it all.
No, I think, yeah. I mean, obviously,
I just took the nucleus of the nachos, bro.
Oh, Tim does that. Sometimes we'll be sharing a nacho or something. He'll be just go right for the best chip. All the guacamole.
We got our own
pico de gallo,
so that we could both eat the nucleus out of the cinnamon roll. We didn't want to share that. That was fun.
If you want to learn about the cinnamon rolls, you should call us. And we'll tell you about it. Yeah. But credit cards, I mean, they can be a great way for especially younger people to build credit and help build credit quickly when you don't have other ways of building credit, like leasing or financing a car or having a mortgage or things like that. So credit cards can be helpful in those capacities. It can also help build good spending habits as a younger person. So I look at it for that regard. Also, the points and rewards that come with credit cards, like Tim mentioned, I think that's also a great use of credit cards. But it's all about how you're using that resource. And if you're using it inappropriately or for the wrong reasons, you can definitely dig yourself into a hole. And I think that's where the myth of the credit card is the enemy really comes from a lot of people. So
I think always pay it off if you always pay it off every month, always.
Yeah.
Credit cards are amazing.
Yes.
And they're no longer the enemy. Anytime you don't pay the whole thing off every month, you're starting to pay way more for that credit card debt than you probably should be paying in your situation. So do everything you can. If you can pay them off every month, you're not paying any interest, typically fees, penalties, things like that. Credit cards can be an amazing tool, but they're just sitting there waiting, hoping that you don't pay off the next month so that they can collect their interest, and that's how they make money.
Yep. Yep. Okay, we got to move on. We're trying to just keep it somewhat tight here. I got 4 more. I'm only going to do 2. I'm going to pick the 2 best
ones.
ones.
We got to hit the 4% rule and the other
okay,
thing too.
All right.
So at least briefly. And
let's do these
lengthy.
quickly.
What do you got? What do you got, man? Pick your 2 best ones.
A high income guarantees financial success.
Oh yeah, no, that's a myth.
What do we call that? Henry? High earner, not rich yet.
Yes,
is a term that gets thrown around a lot. And you see that with people where you can be somebody living on a very small income and be paycheck to paycheck. You can also be somebody that has a drastically high income. I mean, we're talking big income and still be living paycheck to paycheck. It's about lifestyle choices. Lifestyle creep happens as you earn more, you spend more. And I mean, we see it, routinely with people where they're making gobs of money and they still don't really have much to show for it.
Yeah. That's an official term, gobs.
Yeah,
gobs of money. Yeah,
no,
I like
throwing these little.
I like that too. Yeah, that's good. We've seen it with lots of people. In fact, there are clients that will come in. They'll be making $200,000, $400,000, $700,000 a year, and their whole savings is not even equal to 1 year of their income. And they're in their 50s. Like if you want a litmus test of whether or not you've saved well relative to your income, you should probably, by the time you hit 50, you should probably have at least 10 times your income in savings and investments. Now, if you don't have that yet, then you probably have some catching up to do. And if you hit 40, I would say you should probably have somewhere between 1 to 5 times your income in savings and investments. And those are just some kind of quick rules of thumb. And by the time you get to, I would say 60, 65, the income you want to retire on, it would be ideal if you could have, somewhere between 10 to 20 times that income. If you had 20 times that income and you were pulling out 5% per year, that would be the income target that you would need. So if your goose that's going to lay the golden eggs, for example, let's say it was a $2 million retirement portfolio, and you pulled out 5% per year, which I'm not advocating for, by the way, that's still high. But that would translate to about $100,000 per year off of a $2 million portfolio. So that's one way to look at it. But if your goal was $100,000 a year, you would need close to 20 times your income. And realistically, to go to retire, it would be best to be closer to probably 25 to 30 times your income is a good kind of target to shoot for. And and if you're way ahead of that, we can help you figure out how to retire, because you're probably just hanging on because you feel like you have to. And if you feel like you have to, you don't have to. We can help you figure that out. Absolutely. If you feel like you want to, that's fine. You can keep working. Some people just love to work. Yep. I love to do this. I'm going to keep doing this myself for who knows how long.
Yep.
But anyway, there's a lot in there to unpack. But just some good rules of thumb to think about.
Yep. Okay, last one that I have. You shouldn't talk about money. It's taboo.
Oh man!
Oh yeah!
Who are you
talking at the dinner table about money, kids. We're watching TV. We're talking about our days, but don't talk about money. Okay, it's a sensitive topic.
So if any of you believe in that particular myth, then you're listening to this right now with this feeling of guilt.
Like I shouldn't be listening to this.
This is called Clear Money Talk.
Someone walks in the room and you turn it off.
I know. We're literally like your guilty pleasure that you're listening in the closet.
Welcome.
You're not telling anybody. It's like eating chocolate in the closet when you don't want your parents to know or something. Oh my goodness. Okay. Well, yeah. No, I think actually open discussions about money, especially when you're teaching like your children and things like that, are really, really important. And open discussions between spouses or significant others when you're working together to build a financial future together is really, really, really important. And that's a common thing that we see where, one particular party doesn't want to talk about money and the other person needs to talk about money, and so they can get on the same page. And that can create a lot of conflict because there's not that open conversation. And many times we end up being the intermediary that those spouses get to have that conversation about money with, because they come in and sit down with us and we have a nice, open, non-judgmental, non-blaming conversation about money. Which is great. That's what we do.
Yep. Okay, that's all. That's all mine. Okay.
That's all, folks.
Let's go
except for the 2 that I mentioned.
Yes,
so
let's go to those.
Really fast. You can Google this stuff if you want to research them more. But there was this rule out of thumb, that goose that lays the golden eggs, that if you drew about 4% per year, so if you had that $2 million goose and pulled about $80,000 a year out, you'd be pretty secure in terms of not running out of money in retirement, assuming you invested the goose well. That's what the 4% rule is. And I would say that if you do invest the $2 million goose well, that can work. However, people are living a lot longer than they used to. And if you retire at 65 today and you live to 110 or 120, the way people seem to be continuing to live longer and longer and longer, all of those rules that were designed to try to determine how big of an egg can you take off a goose were built towards the theory of a retirement that was maybe between 25 and 35 years long. If your retirement is longer than 30 years, you need to make some adjustments to your strategy. And if you just take that $2 million goose and stick it in a savings account at the bank, it ain't going to work. You're not making enough money on that goose in order to sustain your income stream with a 4% withdrawal. So there are some myths there as far as the 4% rule. I would say that can be a myth. And then the other one, it's funny. When I got in the business in 1997, there was this theory out there that however old you are is the percentage you should have in bonds. So if you were 50 years old, maybe you'd have 50% in bonds and then 50% in stock. Or if you're 80 years old, you'd have 80% in bonds and 20% in stock. And it was a natural rule of thumb, money myth, to, as you get older, getting more conservative with your portfolio, is sort of this rule of thumb. And there was a study done called the Trinity study in 2000, Trinity. And I think it was done at Trinity College. I think that's why they called it the Trinity study.
University,
Trinity University. So the study back-tested all of these periods of time where they were withdrawing money out of these portfolios, and they tested 5 portfolios over a typical 30-year retirement experience. They looked at 100% stock, 100% bond, 50-50, 75-25, 25-75. And the first thing they discovered is that the purpose of the portfolio allocation, the management, money management of that goose, was try to figure out what's the best mix of stocks and bonds for a retiree who's going to retire over a period of, typically 30 years. That was the gist of the study. And what they found when they back tested all these 30-year segments of time, going back into the 1920s all the way through to 2000, and anticipated, what if this was your retirement experience, 1920 to 1950? What if it was 1921 to 1951? What if it was 1930 to 1960? We are all looking at all these 30-year segments of time ending at 2000. They determined that the optimal allocation of those 5 allocations was much more closer to the 75-25 mix, 75% stock, 25% bonds. 50-50 stocks and bonds or anything higher in bonds long-term didn't generate enough wealth to optimize the income stream they were able to generate. And 100% stock was just a little too aggressive in that historical analysis to, if you went in and the market timing was poor, you retired right before Black Tuesday, for example, or something like that, and then you had your 30-year retirement experience. If you were 100% stock, you could see a significant loss and then run out of money, which nobody wants to run out of money. So the point was, it didn't make any sense to have a 80% bond portfolio even if you're 80 years old, or a 70% bond portfolio if you're 70 years old. So that rule of thumb was debunked by the Trinity study, but a lot of people are still following that today as you see it. And I think it's just because they haven't been caught up. They don't know the new stuff. And if you don't make this your career, you're never going to keep up with the new stuff. And that's why we do this. So anyway, lots more there to unpack. And if you want to learn more about it, you can always read my second book, What Should I Do With My 401k? Should I buy an annuity? There's more information in there about the Trinity study and the 4% rule and the goose that lays the eggs and all of that stuff. And if you want to listen to more of our Clear Money Talk shows, that's great. If you learned something smart about money today, please go to somethingsmartaboutmoney.com and get counted so that we can count to our teaching 1 billion people something smart about money goal. And but ultimately, if you feel like you need a financial advisor, or you might want to review or a second opinion about what's going on in your portfolio, give us a call. That's what we do.
That's right.
Yeah.
That's what we're here for.
Yeah. And our phone number is 503-579-1000.
Yep.
We got to do our trivia.
Well, we also got to do just the answer.
Jeez, Pete, man.
Yeah. Okay. I'm gonna hit this one fast.
You hit the just the answer.
Okay. Just the answer. Buckle in. Here we go. What are the biggest money myths holding you back was the topic of our show. Tim and I talked about some of the most common money myths that you might hear at a cocktail hour, at the family dinner table, or otherwise. I'm not going to go through the back and forth Tim and I had about the myths and our insights about them. I'm just going to give you what the myths are, so that way you have FOMO and you have to go listen to the full episode, so that way you can get to unpack the full details of it. So one of the myths we talked about was you need a lot of money to start investing. Debt is always bad. Renting is just throwing away money. Credit cards are the enemy. A high income guarantees financial success. and you shouldn't talk about money because it's taboo. And then Tim also added 2 of his own, which I appreciate. One was the 4% rule, and then the other one was your age dictates the amount that you should have in bonds. So go listen to the full episode to get all of our insights, and give us a call if you have any additional questions after that. Now is time for trivia.
You nailed that, Tyler. That was really good. Well done.
Okay.
Well done.
Thank you.
I had no idea how we were going to do that, so that's good. Good.
Okay, we got to get into trivia because
Go.
it's a 2-parter today, so it's even longer than normal. Okay. All right. Part 1. Which Marvel superhero is known as the Sorcerer Supreme? Is it Iron Man?
No, I know. If you're going to give me multiple choices, it's like the Sorcerer Supreme. I mean, the only guy that comes to me is Doctor Strange. But as the Marvel, I mean, he's definitely the sorcerer kind of guy. It's not Iron Man. Who are the other 2? Is Doctor Strange one of them?
Thor.
It's not Thor.
Scarlet Witch.
Scarlet Witch.
Or Doctor Strange.
Oh, Doctor Strange. Yeah. I mean, yeah. No, I could see the Scarlet Witch potentially being known as that, but no, I'd say Doctor Strange.
It is Doctor Strange.
Of course.
Now, going off of that.
Okay.
You ready?
Yep.
What is the name of the magical artifact Doctor Strange uses to manipulate time? Now you might want that multiple choice, huh?
That's funny because I'm going with. I was thinking Harry Potter and Hermione with that manipulating timepiece thing. That's really cool. And then Harry Potter sent me down the path of funny words, and I was thinking of the Horcrux, which is the stuff for the Voldemort issues, which has absolutely nothing to do with Doctor Strange's timepiece that he's using to manipulate these things.
You're not supposed to say Voldemort either.
I don't know. Oh, yeah, well, that's right.
It's a name we do not speak.
The name, yeah, that's right. I can't remember. He's got the cool cloak. It flies. I don't know.
I'm going to give you some options.
Okay,
Okay. The Tesseract, the Orb of Ashtur, the Infinity Gauntlet, the Eye of Agamotto.
The Tesseract. I think that feels true to me.
No, it's the Eye of Agamotto.
No, really? The Eye of Agamotto. What's the Tesseract?
I don't know, but it sounds
Google
good
that
though.
one later.
Yeah.
I don't remember. Yeah. The Eye of Agamotto. Okay, all right, that's good. I knew it wasn't the Infinity Stone Gauntlet thing. That obviously, there's a whole storyline for that.
Yeah.
Anyway. Well, I hope you enjoyed watching me get one right and one wrong today.
That's good.
And yeah.
Okay, wise words to wrap this up.
Okay.
Our topic was, what are the biggest money myths holding you back? If you feel like there's any money myths that are holding you back, or it's keeping you from doing something, or you feel like it's making you do something that you're not certain about, you should reach out to us. Give us a call, 503-579-1000. We could talk through it, and we can tell you if it's a myth, or we can just help you, in that regard, I guess. So.
Yeah. Retirement income planning is our gig. Like, this is the main thing that we do. So if you've got retirement accounts and you want to figure out how to get the most value out of them and invest them wisely, consistent with your own risk tolerance, I mean, that's what we're here to help you with. So
Absolutely.
Hope to talk to you soon. Thanks for joining us again on Clear Money Talk.
Till next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Advisor Networks LLC, a broker-dealer and registered investment advisor, member FINRA SIPC. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisor Networks LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Networks LLC nor any of its representatives may give legal or tax advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. A diversified portfolio does not assure a profit or protect against loss in a declining market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks, and charges, and expenses of mutual funds carefully before investing. The prospectus, which contains this and other information about the funds, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon, 97035. For more information, please call us at 503-579-1000.